Hi everyone, welcome back to my YouTube channel. Thank you for being here. The Sustainable Business Growth Formula. This video is about how you as a business owner can grow your business without having to acquire external financing. Why growing a business requires cash? You probably have thought about it. How can I as a business owner grow my business without having to acquire external financing? So financing from banks, investors. If you have ever owned a business, then you know that in order to realize this possible growth, you need some way to pay for the growth. You probably need to pay for the increased expenses of hiring new employees, purchasing more inventory, having a larger office, thus paying for more office rent. Remember the following: in life, as in business, nothing is free. Everything comes with a price. So does growing your business. Simply said, there are three ways to pay for that growth. The first one is to acquire debt. So go to a bank or a crowdfunding party that will provide you with a specific loan or credit to pay for that growth. Second option is to sell part of your equity, of your shares. This is the most costly option of all three options. Why? Because you're selling a piece of the pie. And if you would have the intention to in the future sell your business, you would have sold a part of that possible future gain for the financing of your business at this moment. So that is the most costly option of all three financing options. So lastly, there's the option to internally fund the business growth using the profit that is generated by the firm itself. So the firm itself pays for required necessary investments and expenditures that need to be made. It's also referred to as sustainable growth. A good sustainable growth is a growth that a firm realizes without creating any future financial problems. I like to call it an organic growth, a natural growth that is created by the natural cycle of a business, that at the end of the specific period, the firm has generated specific wealth that then is reinvested into the business in order to make the business grow and grow and grow. All naturally, without having to acquire external financing, without having to give away a piece of the pie, piece of the equity. So considering all the pros and cons that we have just discussed, what would you as a business owner prefer to apply? So which method would you want to apply in order to grow your business? Would that be to acquire a bank loan or credit or perhaps sell part of your equity, or do that with a natural growth? Let me hear your thoughts. The sustainable growth rate formula can be used as a decision-making tool by management. As already mentioned, this specific formula, the sustainable growth rate formula, determines the maximal achievable growth rate that a business can achieve without having to acquire external financing. The sustainable business growth formula is calculated as the return on equity multiplied by the retention rate, or in other words, that which the business does not pay out in dividends. I will illustrate the practical use of this specific formula, presenting two scenarios. So two scenarios. Scenario one is where the business owner invests a rather small part of its profit back into its business. In scenario two, the business owner decides to invest a larger part of its profit, of its increase in cash, into the business. Imagine in this case, for both scenarios, the business owner has a strategic goal to grow their business as much as possible. So the growth of a business, in this case the sales revenue, in these examples we will take the profit as the increase in cash. So imagine if a business in this situation has a profit of 100,000, means that 100,000 is the amount that the cash will increase at the end of that period. So let's start off with scenario one. Scenario one is where the business owner decides to invest a rather small part of the profit back into the business at the end of the period. So let's imagine that the owner wants to invest only 20% of its profit into the business. So let's start off by calculating return on equity. So how much income or profit is generated by the firm's equity. So in year one, the business realized a profit of 100,000. The total average equity is 200,000. This leads to a calculated return on equity of 48%. Let's have a quick look at what this figure actually means. This measure actually shows that the equity was able to generate around approximately 50% of its invested value. So the equity that was invested was able to generate 50% profit. So let's assume that this business has a dividend policy of paying out 80% of its profit to its shareholders. This means that the dividend payout ratio is 80% and the retention rate is 20%. That means specifically for this example that 20% of the income of 100,000 can be reinvested into the business, can be used to reinvest in the business and to grow it. In this example, in this scenario, we see that the business owner is able to increase his revenue by 10% by reinvesting 20% of its profit. The sustainable growth rate shows a figure of 10%, meaning that the business's revenue in year 2 is increased with 10%. What we can also additionally derive from these figures is that the sales revenue have increased with around 10% due to having made a small reinvestment into the business. Sales have gone up slightly, but the return on equity in year 2 has decreased. Why? Because net income has decreased with 5,000, but the equity has increased slightly. This scenario is a good example of how a business can become dependent on external sources of financing, of funding, in order to be able to pay for growth. Second scenario, scenario 2, shows a different scenario, is where we look at the business owner deciding to reinvest 80% of its profit back into its business. What we can see from these figures here is that the sustainable growth rate of 33% leads to a sales revenue increase from going from 500,000 to approximately 670,000 in sales revenue. So comparing scenario 2 with scenario 1, we see that the sales revenue has increased relatively much more due to having invested more back into the business. So you can think about investments such as hiring a new marketing manager, marketing employees, or hiring someone with more skills. That costs money. But on the other end, you will have a higher revenue as a compensation. That is your return on your investment that you make in, for example, better qualified personnel. So scenario 2 is a good example of how a firm can grow naturally, organically, from its own cash reserve, from its own profits. So the argument here is that if a company owner decides to use the cash, the profits that the business has generated in order to grow it naturally, there wouldn't be any significant external requirements. There wouldn't be any significant funding requirements that need to be satisfied by, for example, investors or, for example, banks. So having looked at 2 different scenarios, we can say that one option, reinvesting little into the business, leads to slight natural growth, versus investing more naturally into the business leads to a faster, more rapid growth. You can also conclude that the sustainable growth rate can be used as a good indicator how fast and quick the business can grow without having to acquire external funding. So having looked at these options on how to grow your business, doing that either in a natural way from internal funds or acquiring external funds, what are your thoughts as a business owner on what you would prefer to apply? So I would want to thank you now very much for your time, for taking the time to look at this video. I hope you found this video very helpful. And if you like this video, please subscribe to this channel, and we'll see you next time. Thank you. Have a great day.